Hello, today we're going to discuss the results from the stress test by the US Federal Reserve for 2025. You may be familiar with what stress testing is and why banks and financial institutions do stress testing. Just to introduce, stress testing is done to ensure that banks and financial institutions have enough liquidity, enough cash, enough money to sustain adverse scenarios, economic scenarios such as recession and war and so on and so forth. So regulators around the world make it mandatory for banks to perform stress test. As the name suggests, it's about assessing banks' liquidity positions in various bad economic scenarios. And in the US, the Federal Reserve is the regulator there, and it enforces the main banks, the big ones, to perform this exercise on an annual basis. But even the not so big banks and financial institutions have to perform this, if I'm not wrong, once in 2 years or 3 years. Okay, we'll see. Okay, so these are results published a couple of weeks back, and we will see what the results are and how they look like. So it starts with this particular section where it mentions as to why Federal Reserves make it mandatory for banks to perform stress test. As I've said, it's important from a regulatory point of view to ensure that the banks are safe and solvent, because if the banks remain solvent, then the wealth of the depositors will remain safe. Otherwise, depositors will lose money, something that we saw in 2007 and 8 financial crisis, and that can also have impact on the larger economy, on unemployment rate, inflation, and various other areas. Many other companies, non-bank companies, can also go bankrupt if there is a banking crisis, right? In order to ensure that the banking system in a given country is strong and solvent, stress testing is done, right? And this is something that's been there for a while, but it has been more stringent post 2007 and 8 financial crisis, where we saw, it started as a crisis in Lehman Brothers and few other banks, but it slowly had an impact for other US banks, but also other banks around the world, not just in the US, because the banking system today is so interconnected that if there is a crisis in one or a few large banks, you will see that impact is felt even in other banks, not just from the country from where the bank getting affected is present, but also in other countries. So that's therefore is very important that stress testing is done properly and meticulously by the respective banks. Okay, so we'll see what the results are. Okay, it starts with why stress testing is done. The Federal Reserve promotes a safe, sound, and efficient banking system that supports the US economy through its supervision and regulation of domestic and foreign banks. So here is an important point. It's not just for the US banks, but even the foreign banks like the likes of HSBC, which are pretty big also in the US. Stress testing is mandatory. I think some other European banks also are quite big in the US. So any bank or financial institution that is quite big and managing a certain amount of money beyond a certain threshold, it has to comply to this requirement. And how does this work? So the Federal Reserve, which is the regulator over there, would come up with different stress scenarios. Stress scenario could mean, let's say scenarios, let's say unemployment rate increases by certain percentage, there is a recession happening, there is a debt crisis. There are several such scenarios based on macroeconomic variables, and that's provided by the regulator, Federal Reserve in this case. And the Federal Reserve will also provide different models to use for the purpose of stress testing. So the methodology would come from the regulator itself. and the banks then will have to submit data, internal data, and then Federal Reserve would then assess whether a bank would remain solvent given the data the banks have produced or provided the Fed with. So in those scenarios, right, in the hypothetical scenarios, stress scenario, whether these banks will remain solvent or not, right? So this is how it works, right? So it's a collaboration between the regulator and the respective banks. It's not just the banks that do all the activities. Even Fed itself is quite involved in these kind of activities. A lot of the work is done by employees of Fed. Okay, so using the scenario data and bank data as variables in the stress test models, the Federal Reserve projects how banks are likely to perform under hypothetical economic conditions. Why hypothetical? Because these conditions are not already there in the economy. They're expected to be there in the future. Again, hypothetical, so you want to be prepared for the worst case scenario, right? So that's the reason why you have such hypothetical scenarios. Okay, so as part of the annual stress test, there are number of documents that you get from the Federal Reserve. You get different scenarios and the methodology, and then Fed would aggregate results from different banks based on the data provided by these respective banks, and then Fed will then publish some of the results, and this is one of the results paper. Okay, so we go down, so we'll see the summary of the results. It starts with this, the 2025 stress test results show that 22 large banks, so the sample here is 22, subject to the test this year have sufficient capital to absorb more than 550 billion in losses and continue lending to households and businesses under hypothetical stress in conditions. So what it says is that Fed is quite confident that these large financial institutions will be able to survive bad economic conditions, even though the losses would be 550 billion US dollar in total, and yet these banks would still survive, right? You can put a question mark though, simply because we have seen things going wrong in the past, but perhaps in the last 15 years the banking system is the most solvent and most strong. I would say it's the strongest in the last many decades. So you could also argue that the stress testing and the stringent rules with stress testing and capital requirement has made the banks stronger. The CET1 ratio is used as a metrics to assess how well banks are capitalized in these scenarios. So currently it's about 13% to 13.5%, which is the CET1 ratio, and the projected minimum would be about 11.6%, which is about 20% less compared to the normal CET1 average for the 2020 banks. So that doesn't make much of a difference, and yet you would still see a scenario where banks are solvent. Here is a tabulation of that. The common equity tier 1 capital ratio, which is around 13.4, will become 11.6 in severely adverse scenario, right? And that's still well above the minimum regulatory capital ratio, which is about 4.5%. So even in the severely adverse scenario, the banks would remain solvent. That's what it means. Okay. Now the aggregate maximum decline, which we saw, is about 20%, right? But in terms of percentage point, it's about 1.8 or 2.2, right? So that is the decline, right? But in 2025, you see it's about 1.8 percentage point. Okay, that's not big compared to what it used to be in the past. In 2024, it used to be 2.8. One reason is that Fed is now a bit more optimistic about the economy compared to what it was a year back. Okay, there is more stability, uh, recessionary scenarios have gotten a bit better. In 2024, 2023, there was a forecast about a recession coming in the US, but that didn't quite happen, and things are looking a bit better. Especially the inflationary conditions are a bit better in the US. Well, you could also disagree with that, but at least compared to the last 5 years since COVID, 2025 happens to be somewhat better. Although we are going through a number of uncertainties currently through because of war and political instability and so on and so forth. Because of which you see several impacts, several changes in the results compared to last year. Lower loan losses as a result of less severe scenarios. So the hypothetical scenarios provided by the US Fed, they're less severe now compared to what it was in 2024, simply because Fed is more optimistic about the economy for 2025, 2026. Also a bit strange in my view, because we still are grappling with a number of economic uncertainties related to war and political instability, and inflation is still quite a big topic, and interest rate cut is yet to happen in proper way in the US, but Fed for whatever reason is optimistic, and hence the scenarios are not that severe as it used to be into the 2024 2023, and because of which you see the expected losses in those scenarios are somewhat less, right? And then there is a change in which the private equity losses are accounted for, and there is a methodology change, so that is also having an impact. So part of the impact is, okay, the economic scenarios are now a bit better compared to what it used to be, so that one. So the hypothetical scenarios are also a bit revised and better and not that extreme, but also the methodology has changed, that is also having an impact. Okay, so this is about year and year plot for maximum decline in stress common equity capital ratio over time, 2024 stress test and 2025 stress test. This is a comparison. You see there is a bit of impact because of the scenarios which is accounted for in the PPNR, the pre-provision net revenue, but you also have expectation that in bad scenarios probably the banks will be benefiting a lot from the from trading activities, which is strange, by the way. Many economists, many bankers are now questioning that, but you see a positive impact because of banks making money during economic scenarios, and that offsetting some of the losses from the lending side. Okay, so there is a positive impact here, and the impact of the scenario themselves also has some impact, and change in methodology for private equity is also having some impact on the overall change. Okay, so here are the scenarios, right? Unemployment rate in severely adverse scenarios, about 10%. Real GDP decline would be about negative 8.5%, whereas in 2025 it is 7.8%. So that is it's a bit better. It's still negative, but it's better, right? House prices declining by 36%, right? Quite strange, right? 33%, 36% going down in a year time. Nobody expects that, but that has happened in the past, and that's why you have such hypothetical scenarios, right? Last year it used to be 36%. That was the estimation in a severely economic scenario, that house prices would go down by 36%. In 2025 it's estimated to be 33%, so that is somewhat better. Equity prices going down 55% in 2024, 50% in 2025, so on, right? Okay, so you see significantly higher projected PPNR or pre-provision net revenue under stress, primarily as a result of strong recent profitability and models that are sensitive to recent data, because the methodology used for PPNR calculation is somewhat biased towards recent data, and recent years haven't been very good So you see an increase in expected losses, but that is offset by making money through trading positions. That's what Fed is arguing here. And then there's some impact because of changes to the stress test framework. Okay, in this year probably, a rule to average the stress test results over 2 consecutive years to reduce the volatility in capital requirement. So because of averaging, there is also an impact. So this is a change in methodology. Okay, what else is there? Now you see that this is a stress test where not all the banks have participated. There are 4 types of banks or financial institutions as per the US Fed, which are required to do stress testing. There are like category 1, category 2 and category 3. Here is the definition. Category 1, the G-SIB banks, the global systematically important bank, the large banks, and then you have domestic banks holding or foreign banks with above 700 billion or more in assets, or 70 billion or more in cross jurisdictional activities. And then you have banks with 250 billion assets or 75 billion weighted short term wholesale funding and non-banks. And the last type of, which is the 4th category, is US intermediary domestic banks or foreign banks with 100 billion asset under management, right? And so for this particular year, the first 3 category have to do it. So if the first 3 category 1, 2 and 3, they have to do this stress test every year, whereas the 4th category has to do it once in every 2 years, right? So this year it is only for the top 3 categories. And this is the list of companies in the US which are doing this, and you have a categorization here. Okay, the aggregate common equity ratio, it has increased quite substantially over these years. In 2009, post crisis, it was around 6%. Now it is well above 13%, which is a significant change. And that's why I said, because of the stringent regulations, the capital position of most banks around the world, not just in the US, has increased, has become better, and therefore the financial system or the banking system is more solvent, stronger compared to what it was 15-17 years back. Alright, so if you want to read more about this paper, I will provide a link in the comment section. Thanks. See you next time, guys.